Hi, and welcome back to the Business Career College video series. Again, this is Jason Watt, and what we're going to talk about in this video is the defined benefit pension plan. This is a follow-on to the video covering the registered pension plan, and it might be useful to have watched also the videos covering the RRSP at this point. The defined benefit pension plan is an employer-sponsored pension plan. And in this employer-sponsored pension plan, the employer makes a promise to the employee, and the promise generally looks something like this. The employer says, okay, employee, we promise that when you retire, we're going to pay you a pension based on your number of years of service. So we take however many years of service you have, and we're going to multiply that by a percentage. That percentage is going to be a maximum of 2%. And we're going to multiply that by your salary, and we're going to multiply that either by your final average salary. That is, we might take your last few years of employment and average those together. We might take your career average, take everything you did while you were working for us, and average that together. We might take your best earnings, that is, take, say, the best 3 or the best 5 years, usually consecutive, that you put in with us, and pay you a pension based on that average. So a fairly typical provision here would look something like this. Let's say we have an employee who has 30 years of service. This person retires with 30 years of service. They are on a 2% pension plan, so a pension where we promise 2% of their income, and this person retires with $70,000 of, let's say, final average earnings. Okay, so we can see then that's going to be 30 years times 2%. That would be 60% times 70,000. This person will end up with a $42,000 annual pension. There is another sort of option here as well. The fourth option, the option you'll sometimes see typically in trade unions, is what's called a flat benefit plan. And a flat benefit plan doesn't use the career average earnings or any of the average earnings formulas. Instead, it builds basically per hour or per day or per week. This is common in union jobs where you have, for example, a union welder, boilermaker, whatever the case is, a carpenter, something like that, and this person may not be in a situation where they actually would have a calculable career average earnings. Instead, every hour, day, or week that they're working on those union jobs, their pension would build by a flat amount, which is why we call it a flat benefit plan. Those are common in trade unions, but really not anywhere else. So that's our calculation. We can see this person now is going to have this pension from retirement right up until mortality. And it's actually pretty common as well that we would have a provision in here that says that not only are we going to pay it until this person's mortality, but we would typically have a joint and last survivor annuity benefit where we would pay it until the death of the last of them and their spouse. So we typically have joint and last survivor. It might be helpful to go back and review the annuity videos in order to understand how the joint and last survivor annuity works. Now, this is very attractive from the employee's perspective. If you know you can retire with a generous benefit like that, hey, that's going to make retirement fairly easy to plan around. And you would have, in addition to that, Canada Pension Plan and old age security benefits most likely. So you'll have a fairly comfortable retirement here, and you don't have to worry. You don't have to get up every day and check the markets or worry about the timing of your investments or whatever the case is. You know you're going to have this fairly comfortable retirement. However, the employer in this case, who makes this promise, has a lot of uncertainty. And the reason the employer has all that uncertainty is because they have to figure out how to put aside enough money to make this promise for you. Now, typically, we're going to have both the employee and employer contribute. So both the employee and employer are making contributions. And as we've previously seen, those contributions are tax deductible. But as we've also seen, the employer has a fiduciary responsibility to make sure that there is enough money sitting in this plan to make it work properly. So how much money do we need to have sitting in this plan when the employee retires in order to provide a $42,000 annual pension? Well, that's a whole lot of it depends. Okay, so it depends on a lot of factors. It depends on the age of retirement. Now, we can do things to try and encourage employees to retire at certain ages, and a pension typically has a normal retirement age, which is the point at which the employee could retire on an unreduced pension. But that doesn't prevent the employee from potentially retiring earlier, probably with a smaller pension, but then they're going to collect it for a longer period of time. We also don't know how long the employee is going to live. So we don't know the employee's mortality. And we also don't know their spouse's mortality. If they are married or in a common law relationship and the insurer is under a responsibility, or sorry, the employer is under a responsibility to provide that joint and last survivor benefit, we're worried not only about the employee's mortality, but about their spouses as well. We also don't know what kind of investment returns we're going to get along the way here. If we get very good investment returns, that's going to help us have an easier time putting together the lump sum we need to provide that promised pension benefit. But if our investment returns are poor, that's going to adversely affect the employer's ability to fund this pension properly. They're going to have to put in more money to take care of that. We also are not sure here about the influence of inflation. So if inflation ends up being a problem, that is, if inflation ends up being greater than expected, and this pension benefit is indexed, which is a very common provision, then inflation can cause us a problem. And especially if investment returns are low while inflation is high, which is a relatively rare occurrence, but it does sometimes happen that way. There are other factors that can cause a problem from the employer's perspective as well, and these are factors like employees who leave early and possibly have the ability to access their funds in the plan as a result, which hurts the overall amount of reserves in the plan, or, and it maybe doesn't seem like it should matter, but employees who die or get divorces, these are all factors that can influence the amount of money that sits in the plan. So the problem here from the employer's perspective is that we have an awful lot of uncertainty for the employer. And the theory goes then that the employee has certainty, that is, the employee knows that their employer is going to be looking after them here. Now, the reality is what we've seen with defined benefit pensions is that there have been some funding problems here. So the employee knows that they're going to have this pension unless there are funding issues. And we have seen some of this with defined benefit pensions in Canada. In the case that there are funding issues, you could actually have an employee who figured that they were going to have that great $42,000 annual pension, and at some point the pension runs out of money or has to cut back on the promised level of benefits. On the whole, though, most employees know that based on their contributions throughout their working years, their employer is going to be able to live up to this promise and pay them this very generous defined benefit pension, which is going to help them make their retirement quite a bit easier. I hope this helps to understand how the defined benefit pension works. If you have any questions, please do let me know. Thank you very kindly.